I think this, from what I've heard from people that know a lot more about viruses than I do, that unfortunately this will make it through the summer, and in terms of having a vaccine, it's a long ways off. So you've got it is scary stuff. I don't think it should affect what you do in stocks, but in terms of the human race, it's scary stuff when you have a pandemic.
It's a scary time for the human race, a scary time for the economy and for financial markets. There is a war on confidence. On the positive side, we have $2 trillion of stimulus in the US, $330 billion of stimulus in Australia, and all of that is trying to maintain the people's confidence, because the economy really comes down to spending and confidence. If, with our best luck, we have a short period of disruption, and there's a lot of stimulus, low interest rates now, with oil prices very low as well, and we can get the economy going again, things might be in a V-shaped recovery, a very quick recovery, and we go on. On the other side of things, on the negative side, we have the US now with more cases than China and Italy, and the New York area and California have both shut down. If there's a shortage in goods, there could even be an inflation spike if people need to pay more to get goods, and also with the money printing, if that increases the money supply and so on. It really will depend on how long the shutdown and the virus continues in this format, and how our confidence all comes out at the end of this. As we know, confidence, a bit like a graph of the share market, that falls very quickly and rises quite slowly. Let's go to Howard Marks, as a famed credit investor in the US. Let's see what he has to say about his thoughts on the current situation.
Some things are trading at distressed levels.
Yes.
The market certainly isn't, or even close to it.
Overall stock market is
Sure,
not.
well,
Right.
or the credit market for
Right.
that matter.
Right.
Do you have a sense as to whether this will become the distressed credit opportunity that Oaktree and others have been waiting for these painful years of relentlessly rising stock markets?
Well, I would guess that it will. Now, what I can't tell you is the magnitude. Is it a replay of 2008? Can't tell you. Or of 2000? Can't tell you. The real question is, how long will it last? Among the things that we don't know, as you enumerated, is whether it's going to last 2 months and the virus is going to disappear when the warm weather comes, or 18 months, which is when the outside date when Mr. Fauci says we'll have a vaccine. Well, that's a lot of spread. If it goes 18 months, we're going to have a serious event here, economically speaking.
Howard Marks talks about different scenarios, whether this lasts for a couple of months or whether this goes out longer, 12, 18 plus months, and the complete different scenarios in both situations. He says that in a memo that he recently wrote that, there's a bull case as well, that if people get back to work in 6 weeks' time or so, things open up, and then there's this $2 trillion of stimulus with very low interest rates and low oil prices, you could get something like the 1920s, the roaring 20s back in 2020s. So there is that scenario. However, there's also the other bear scenario where the things don't normalize very quickly, shutdowns take longer than we think, confidence falls, and therefore, as confidence falls, we know that the recovery in confidence takes a lot longer. So with the two different scenarios, we're not sure, nobody knows exactly what's going to happen, so we have to look at what are the best investors saying. On this channel, we don't give you any advice about you and your circumstances. What we do is we break down what the best investors are saying so that we can learn and take lessons for your education. Let's start with Warren Buffett. How does he handle troublesome situations and short-term shocks to confidence? How does he handle that in his long-term investment approach?
There's always trouble coming. There was trouble coming in 1942 when I bought that first stock, all kinds of trouble. Philippines were going to fall pretty soon. There was all kinds of trouble in 1949. There was trouble, certainly trouble in 2008 when I wrote an article for the New York Times. I said trouble is coming, but I said buy stocks. A net buyer of stocks, or I've actually been a personal net buyer of stocks ever since I was 11, every year. There's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them. Now, I haven't bought stocks every day. There have been a few times I thought stocks were really quite high. And I've even written an article once or twice, but that's very seldom.
But you wrapped up your partnership at one point.
I wrapped
too,
up my partnership once
because
of
you
that.
thought it was too expensive.
Yeah.
Okay. But this is not a time like that?
We own $240 billion worth of stocks. Now, we look at that as $240 billion worth of businesses that we own parts of. But I love owning those businesses.
You've also got more than $125 billion in cash sitting around.
Yeah, well, we'd like to buy more business.
Warren Buffett talks about there always being trouble around the corner. In 1941, when he bought his first stocks, that was the year of the Pearl Harbor attacks. In 1949 and 2008, when the financial crisis was happening, everything was falling down. And still, he was saying, buy stocks. There's an article, I've posted it below in the notes for you to read what he said in 2008. So why is someone who's so positive on stocks, has 240 billion invested, now got 125 in cash? Let's look at an interview from a couple of years ago to see if we can shed some light.
You also said in your letter that's so interesting is that you've got $116 billion in cash, at least you did at the end of the year, that you'd love to put to work.
Right.
But when you look around, you have a hard time finding values. You said basically prices for decent but far from spectacular businesses hit an all-time high.
That's true. I'm fairly confident that we'll find ways to deploy money. I mean, we are deploying money right now, but we'll get a chance as we go along based on history. It's gone a long period now. We've been in a bull market, and the best chance to deploy is when things are going down, obviously.
In 2018, Warren Buffett said there was $116 billion that he would have loved to put into businesses, although they were trading at record highs, and that there'd been quite a long bull market, and history indicated to him that at some point there would be a downturn and he would be able to invest that money again, as downturns generally bring lower prices for businesses that he really likes. Now, this up and down cycle in the market is something that Howard Marks talks about. He talks about the psychology of an investor, how people get very excited, and when markets go down, they get very sad, and the behavior drives prices a lot higher and for longer than we think, and a lot lower and for longer than we think. Let's look at what Howard Marks has to say.
Number one, you have to understand the role of emotion. You have to understand that fundamentals don't fluctuate that much. Emotion and psychology fluctuate much more. You have to understand the importance of being unemotional. Not easy. If you are as emotional as the typical investor, you will do the same things as the typical investor, that is to say, buy at the top, sell at the bottom, and certainly you will not outperform. You have to try to do better. How? By being unemotional, by hiring investor managers who are unemotional, by not tampering with the process. But we always did it with trepidation. We never said we're buying and we're 100% sure it's the right thing to do. We said we're buying and we think we're right. We buy some. Maybe it cheapens further. Maybe we buy more. By the way, one of the big mistakes you can make is to wait for the bottom. A lot of people say, I'm not going to buy. I'm not going to try to catch a falling knife. Rather, I'm going to wait until the dust settles and until the uncertainty is resolved. And guess what? When the uncertainty is resolved and the knife has stopped falling, the bargains are gone. You get the bargains during the decline when everybody else wants to get out.
Howard Marks takes us on an emotional roller coaster. He talks about the exhilarating feeling of going up and that of coming down, the fear and the fact that as knives are falling, the biggest bargains are present, but that's when no one's wanting to buy. And that the majority of investors do make mistakes with getting in and out in terms of buying and selling the market at the wrong time. There was a survey done by the S&P Dow Jones Company showing that if you were to buy the biggest 500 companies in the US, that the majority, 90% of fund managers couldn't beat those simple 500 companies after their fees. And in Australia, that the bigger fund managers couldn't beat just buying the bigger 200 Australian companies. So that says that it's not just the amateurs that do badly at controlling emotions and investing and picking stocks. The professionals do a pretty bad job over the 15-year period as well. Emotions is what often makes investing so difficult. People panic sell, they get completely out of the market, and then they have a very hard time getting back into the market. And it's this buying and selling that historically has led to worse performance. If you think, are you confident enough to be able to pick certain assets and certain prices? Or are you better off being more simple and more relaxed about your investing, hands off? If we're not as confident as Warren and Howard, what about in certain scenarios? For example, we looked at the last 15 years where the big 500 companies or big 200 in Australia did better than many fund managers. But what about if that was a different economic environment? For example, in 1965 to 1981 in the US, there was an inflation and also higher interest rates after the inflation that then made companies really not perform very well. From 1965 to 81, the Dow 30 companies really didn't move over that long 17-year period. And so how would you feel if you were in that scenario and your investments did that? Also, for example, Japan, from their peak in 1989, have yet to recover. Their share market has yet to recover. So there are different scenarios, and our confidence level and knowledge and understanding will determine our performance over time. Let's quickly recap a little bit about what we've learned today in terms of Howard and Warren.
The great investors are optimists. They believe in the human race, they believe in companies that will serve the race going forward, and they invest in those companies for a share in their future profits. They are also realistic. They know that there are going to be times where the psychology, whether it's fear or whether it's excitement, are going to push markets high and higher than we ever thought, and lower than we ever thought, and for longer than we ever thought. That markets go up and down in big cycles, and there will be times where they can take that opportunity. Short-term shocks can be opportunities for their long-term plans to buy companies that they really, really like at prices that they think are the fair, right prices. They are completely confident in their skills to be able to identify the price that they feel comfortable with, and that in the very future, they're very confident and optimistic about how things will turn out. We found that in the last 15 years, many professional fund managers did not do better than just simply buying the biggest 500 companies or the biggest 200 companies in Australia against their performance after fees. However, we do note that there are periods of time, also long periods of time, where the economy and markets don't act the same. For example, the last 15 years, the share market and the economy and so on have done quite well, but in the future that could change. There could be different economic environments that provide different performance, and that's why it's very hard to say that what happened in the past is going to happen in the future. Now let's have a look at some questions thinking about investments. Some questions to ask ourselves. Do we feel completely comfortable in the future, optimistic, or are we more pessimistic? And do we believe in companies prospering in the future, or do we think that potentially things will go down and things will be bad in the future? Are we believing in our own skill set? Do we think we can pick stocks and we know how to value a stock, or do we have to pick more companies and groups of stocks to kind of diversify them and to hedge our bets a little bit? Are we completely invested in one country, or do we have diversified investments across many countries? We have to think about, are we comfortable for a big fall in our stock market portfolio? If we're not comfortable in stock market falls, then should we be owning stocks at all? We've got to ask ourselves these questions. We've got to be real with ourselves. There are many other investments, not just the stock market with Warren Buffett, but there's credit markets with Howard Marks. There's bond markets, there's gold markets, there's property markets, and there's cash. There are so many different investments, and we have to be very true to ourselves about what we feel comfortable with and what we'll do well with over time. There's no issues with that as long as we're honest with ourselves. This video did take some time to make, and if you did get value out of it, please like the video and subscribe to the channel, because YouTube will then send it out to a lot more people to help more people with what they're doing and educate them. For those who do feel like the share market's a good place and they are optimistic and enjoy the share market and think it's a great place to be, I'll leave you with CNBC's top tips from Warren Buffett for investing over the long term, and I'll see you in the next video.
I never know what markets are going to do. I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important. We're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down. I think every business should be run as efficiently as possible, and some are and some aren't. We try to buy the ones that are. I mean, I bought my first stock in April of 1942. I was 11, Pearl Harbor had happened 3 or 4 months earlier. We were losing the war. I mean, you want to talk about a bad outlook for the country. The country's not going to go away. The plants aren't going to go away. The people aren't going to go away. The talents aren't going to go away. The country will grow in value over time. Now, who gets it is another question, but